Calgary market update here. We do this every seminar. We've just got the stats for April, it being the beginning of May. So a couple of numbers that I need everybody to look at. I'm just going to move things around on the screen here. Total sales. So 2021 to 2022. 2022 is 40% higher in the number of sales. There's been over 12,000 sales so far this year in the Calgary market. That's compared to 9,000 last year, and last year was a hot market. So we're starting to read articles about the market slowing down in Canada. Where it's slowing down is Vancouver and Toronto. Calgary and Alberta are still going strong. And the reason we think that it's still going strong is if you look down at the bottom right of the screen, the average price year to date 2022 is $535. So that is so affordable compared to the bigger city centers in Canada. If you look at, we talk about this all the time, Vancouver and Toronto's average price are over $1.5 million. So we're $1 million behind these bigger city centers. People are starting to realize that, and we're starting to see people move here to actually live in these affordable places.
And we've always said that our base here in Calgary, our average should be around 650. So people always ask us, how's the market going? Should I get in? Of course you should get in. We've got a long way to go. Calgary is so attractive. And Tim, we actually bought a property today. We did a home inspection today for a couple in Ontario that are just investing here just because they can cash flow on it. So that's going to continue, but we can finally tell you that we picked up 4 properties in the last week for our clients, and not one of them were in competing offers. Yeah,
and if you were on our last seminar, 2 weeks ago, 3 weeks ago, 4 weeks ago, every property we went into was in multiple offers. And because we cap our investors, so where the dollars make sense, we were losing a lot of these properties because to go over that price point, they would be in the negative cash flow situation. So we were losing a lot.
Yeah, and you're right, Tim. Some of those price points, we've seen people pay for half duplexes in Forest Lawn, $450,000, and we're just like, you're crazy. Okay, so some of these prices are just ridiculous, and we're not going to do that to our clients. We're going to make sure that they're buying the right property, and it's going to continue to go up, and that they're not overpaying. That's key. So we actually, yeah, you're right. We miss out on deals because we're so selective on what's going to make our clients money. And that's why our company's called Calgary Real Estate Wealth. We have that in mind all the time. And if you're buying your own home, we keep that in mind and we find your dream home at the same time. But that's what's going on in the market. We feel that this is a better market this week for us, Tim, than the last seminar. Because I remember coming in saying we put 5 offers in for 5 different clients at the last seminar, and we got 1 deal done. So this time I think we put 5 deals. Katie didn't get done. Yeah. We put 5 deals in and we got 4 for 4 different clients. So it is getting better. And I think it's going to continue that way, Tim. I mean, the properties coming on the market, they're still selling more than what's coming on, but we still have more of a chance right now with what's going on.
Yeah. And so before we get into the mistakes that people make when analyzing properties, before you even start analyzing, you need to find out where you are financially. So going through a mortgage document checklist, talking to a mortgage professional, one who's hopefully real estate investment savvy, like Danielle, who we're going to bring on in just a minute here. So you need to know where you are, because then if you can't really acquire any properties and you don't have any JV partners, analyzing properties is just an exercise in futility. We want you to know where you are, so that when you go out and you analyze properties, you know exactly what type and where you can get it and for how much. So now we'll bring on Danielle. She's going to talk about the state of the mortgage market right now. So if you can jump on, Danielle, and start your update.
Perfect. Thank you guys for the introduction. So I just wanted to chat about something that's really come up a lot lately and is absolutely affecting people's purchasing power and their ability to buy in today's market. So as we all know, rates have been on the rise and they are continuing to increase. So some are actually increasing tonight again. So it just goes to show us that we kind of need to get used to this new normal of interest rates. And with this rise in interest rates, there's added complications. And the biggest complication we're seeing is qualifying. So to explain, when you're purchasing a home anywhere in Canada, you have to qualify for the mortgage. So that involves credit, income, debts, the property you want to purchase. And basically we do a bunch of calculations to tell you what the maximum is that you can spend. Part of that equation, and a big part of it, is the interest rate that we have to use to qualify you at. And the Bank of Canada has set this rate. So typically for the last quite a while, the rate has been 5.25%. So that is not the rate you pay. I just want to clarify. That is just the qualifying rate that we use to calculate, to do the math, to tell you how much you can spend. So now typically that 5.25% we would use to qualify you for a variable rate mortgage, a fixed rate mortgage, a home equity line of credit, basically any type of mortgage. But what's happening right now is that because fixed rates have come up so much, the qualifying rate is actually not applicable anymore. And there's a higher rate we have to qualify for. And most people don't know about it. So what does this mean for you as a home buyer? Right now, on average, a home buyer can qualify for $30,000 to $40,000 less than they did a month ago. And why is that? Because in order to qualify for that same mortgage, we could have used 5.25% a month ago, but now we have to take the rate and add 2% to it and qualify. So for variable rates, the 5.25 is still applicable. But for fixed rates, where we're seeing rates, 379, 389, 399, 409, 424, try adding 2% to that. And let's get up to 609 or 624 for a qualifying rate. Compare that to the 5.25% a month ago. And that is almost an entire percent higher that you have to qualify at, which is why you're qualifying for $30,000 to $40,000 less than you were a month ago. So the difference in rate means that home buyers can't spend as much as they could. Combine that with the house prices increase, and we kind of have a little bit of a disaster. You're stuck purchasing a lower priced home. Or are you? So what we like to do, those of us like myself who are creative, we've figured out a bit of a trick. So if you start off by taking a variable rate, whether that's the rate you want to end up with, maybe you love fixed and you absolutely want fixed, but by starting off on a variable rate, we're still able to use that 5.25% qualifying rate to qualify you to purchase, which gives you the purchasing power of $30,000 to $40,000 more than if you were to take a fixed rate. So by using that qualifying rate up front, we can get you that house that you want without having to reduce the amount you can spend. Then once you take possession of that home and you get those keys, you can reach out to the financial institution and lock that rate in to a fixed rate. So you end up with a fixed rate, maybe, which is what you wanted, but we use that lower qualifying rate for a variable rate and take the variable up front so you can still qualify for that higher priced home. So it's a bit of a trick. Not many people are doing it. Not many people know about it. If you haven't been told about it or haven't asked about it, anybody that was pre-approved a month ago, you're going to want to recheck that pre-approval, because you're going to want to make sure that if you're taking a fixed rate or you go outside of that pre-approval rate hold, that you can still qualify for the same price that you did, for example, 30 days ago. So a little trick, a little trick there to help you still qualify for the price point you want, but make sure you understand that if you take that variable up front, when you go to lock into the fixed rate after possession, you'll be locking in at whatever fixed rate the lender offers you at that time. So there is a little bit of a risk to it. But again, it allows you to keep that 30 to 40,000 higher of purchasing power. So that's my kind of little tip Tuesday for you guys.
Awesome. Thanks, Danielle, for that market update. That's awesome.